Good morning, good morning, good morning. Welcome to today's Friday edition of the Morning Blast. It is the 7th of March. Before Mr. Michael Brown and myself kick off, let's get the legals out of the way. So, as usual, nothing discussed in this basis session constitutes trading or investment advice or infers any kind of endorsement by PIQ Global Limited, as PIQ or PIQ Suite, or indeed that of the hosts, which, as you know by now, is Mr. Michael Brown and myself, Mr. Ryan Paisley. Good morning, Mr. Brown.
Good morning, Ryan. Good morning, everyone. Happy Friday. Happy Jobs Day as well. The end of what has been an incredibly long week for us all, I think.
And not only because you've seen me twice already.
Yes, and a third time later.
Yes.
Some sort of penance that I'm serving here,
Wow.
I think.
And do you know what? And I wasn't going to mention the fact that yesterday you told me that you were extremely happy that I had to cancel yesterday morning because, the quote, you were hungover to fuck. And I wasn't
Yeah,
going to
that's true,
mention that.
actually.
And I wasn't going to mention that at all. But there you go.
But nevertheless, I am fresh as a daisy this morning.
Oh,
So,
beautiful. So am I,
indeed.
surprisingly so.
I'm very surprised.
Anyway, cracking on. What's been going on?
Oh, what's been going on? A lot to get through once more. Good morning once again, everybody. It was another pretty grim day on Wall Street on Thursday, with the S&P 500 closing down by around 1.8% and the Nasdaq 100 losing almost 3%. The latter now trading more than 10% below the all-time highs set towards the middle of last month. So that does mean that we have now met the definition of a correction for the tech-heavy index. And thankfully, President Trump has told us why the market is selling off, having said yesterday that he doesn't even look at the stock market, which I think is a barefaced lie. He then claimed that globalists are behind the stock market sell-off. Answers on a postcard, answers on a postcard, please, if you can explain that one. What was interesting, though, yesterday was that the market did dump in that fashion, and we see continued softness in European futures this morning, despite a little bit of tariff reprieve. The United States yesterday pausing tariffs on Canada and Mexico, which of course went into place on Tuesday morning, but goods that are compliant with the USMCA trade agreement, tariffs on those goods will be now paused until April the 2nd. And I think various folk on the sell side have estimated the proportion of these goods, but it's about 90% of all trade that flows across both borders, whether that be the Canadian border or the Mexican border. So effectively, we're now in a situation where the United States has put tariffs on its closest allies and then excluded pretty much everything from those tariffs that they've put in place about 48 hours later. And I think this is quite good evidence that, in my mind, what is driving the significant amount of risk aversion that we see with treasuries having advanced across the curve once more yesterday and the 2-year coming back below 4%, what's driving that risk aversion is not necessarily the policies themselves, it's the fact that the policies are changing almost by the hour, if not by the minute, at this moment in time. And I think that's the real issue for financial market participants at the moment, because it makes an environment where it is basically impossible to have any idea how to price risk. And as a result of that, people are just going, well, I'm not going to take any risk at all, and really trim their exposure not just to equities on Wall Street, but also to US denominated assets more broadly, with the dollar index this morning trading at another 0.5% lower, having lost about 1% or so yesterday, and trading to a low of about 103.5 as we speak. And I think this is the key point, is that it's more about the way in which business is being conducted as opposed to the business itself that is actually being conducted, if that makes any sense.
It's like, it's the oldest market cliche in the book, isn't it? It's markets hate uncertainty. And at the moment, every day you're just waiting for another tweet to come out and you have no idea what it's going to say.
Absolutely. And I think, unless and until that degree of uncertainty begins to lift, naturally markets will have more of a defensive bias.
Yeah.
Rallies in the equity space will be viewed as selling opportunities rather than buying the dip. We're kind of in sell the rally mode. But of course, again, that could all change on a sixpence depending on what Trump says on Twitter or what Lutnick says in his next TV interview. There were a few other bits and bobs going on yesterday besides the political developments out of Washington, D.C. And I think obviously the most important was the latest ECB policy decision over in Frankfurt. The Governing Council, as expected, delivering a 25 basis point rate cut, in turn lowering the deposit rate to 2.5%, in line with consensus expectations and also in line with what money markets had fully discounted in advance of the meeting. The ECB's policy guidance was pretty much a copy and paste job from what they issued after the January decision, again reiterating that they will take a meeting by meeting and data dependent approach to future policy decisions, while affirming that they are not making a pre-commitment to any particular policy path. That said, the commentary on the overall policy stance did take a bit of a hawkish twist, the ECB noting that rates are, and I quote here, becoming meaningfully less restrictive, in a nod to Isabel Schnabel having rather won that battle with Christine Lagarde, and also potentially a nod towards a slower pace of easing over the remainder of this year. The ECB also gave us their latest staff macroeconomic projections, which saw inflation nudged higher in the short term but unchanged further out, and also saw growth expectations revised down in both 2025 and 2026. We then, of course, moved on to President Lagarde's press conference, which, even by her standards, was absolutely dire. I don't think there was really any signal to be taken from what Lagarde was saying, particularly when she started using some convoluted analogy about the Atlantic Ocean to try and explain what the ECB are doing in their policy approach.
She did have, in her defence, though, she did have a marvellous suntan yesterday.
Well, yeah, when you're the same colour as your orange jacket, I mean, it's quite impressive, isn't it? Who's got the better fake tan, her or Trump? Answer that one in the comments. That said, ECB, and I do need to have a little bit of a rant about this actually. Yeah, go and make yourself a cup of tea. Lagarde did say that the decision to deliver a 25 basis point cut was a consensus and that nobody on the Governing Council was opposed to that move. She did, though, then go on to say that the Austrian representative on the Governing Council, Robert Holtzmann, abstained from the vote. You're a central bank governor. You have one job. I know he's a hawk and I know he doesn't want to deliver a rate cut. Go and fucking vote against it then. Don't just turn up in Frankfurt and go, nah, don't fancy it this time around. I'm going to sit this one out.
On a broader theme, I fucking hate abstentions, full stop. I've said many times, even like MPs in Parliament, you're there to vote on behalf of your constituency. You can't just abstain because you don't want to upset people. That's your role. It does boil my piss when people abstain, when they will literally, like you said, they've got one job.
No, and that did annoy me. If you want to, if you are a hawk and you believe that delivering a rate cut is the wrong thing to do, stand up for that. Vote against it. Exactly. Explain that position. The ECB members speak about 15 times a day. No one's going to go, "Oh, why has he done that? And can he explain it?"
We all know why.
Well, exactly. It's just bloody ridiculous. Get rid of the bloke. He's clearly out of his depth.
Bloody ridiculous.
Anyway, moving on from that, we did have some ECB sources stories doing the rounds yesterday, mainly while we were in the pub. Reuters reporting that the chance of a pause in the cutting cycle in April is growing, but that the 2.5% deposit rate is unlikely to be the bottom of the cycle. And then Bloomberg sources stories, which were out a couple of hours after that, were pretty much in line with those reports as well, saying that officials are preparing for what they are calling difficult negotiations over whether to cut rates further or to hold steady at the April meeting. What I would say, and this has become a bit of a theme of the ECB of late, there isn't actually that much of a gap between now and the April meeting. I think the next ECB decision is only about 6 weeks away. So it would be quite easy for them to say, we haven't had enough data in the intervening period in order to take further steps towards policy easing. So on balance, a hawkish decision from the ECB yesterday, a hawkish 25 basis point cut. And again, we see further euro demand coming in with euro dollar trading around 0.6% higher this morning. Testing 108.5 to the upside as I speak. A couple of other bits and bobs just worth mentioning. We have had some sources stories from the Bank of Japan. They broke about 10 minutes ago. Bloomberg reporting that the BOJ is said to lean towards holding rates steady at the March meeting, instead choosing to remain on hold as they monitor the impacts not only of the hike that was delivered in January, but also the shambles that is the US policy approach at the moment. Of course, the BOJ announced their policy decision on the 19th of March. Those sources stories very much in line with market pricing, in fact, with the next 25 basis point hike not fully priced until the September decision. Last couple of things from me before I throw back to you, Ryan. We did hear some reports yesterday, again, back to the United States. Some allies of the US are reportedly looking to share less intelligence with the states. This is apparently as a result of the approach that Trump is taking to Russia. Apparently, members of the Five Eyes Alliance, as well as Israel and Saudi Arabia, are worried that what they share with the United States may end up in the wrong hands, which could compromise some of their sources. And last but by no means least, literally as we've been speaking, there have been reports that Rachel Reeves has met with guilt dealers to discuss the economy. So, well, hopefully they told it to her like it is, but certainly that's not going to solve anything.
Well, funny, yeah, because obviously we were I actually went to Tayab's, the Indian, with a couple of guilt dealers last night, and I'll give you a clue. If she was speaking to any of those ones, good luck to her. Quite frankly, it's the state that I left them in. Yeah, good one. Anyway,
dear.
thank you very much for that, Mr. Michael Brown. So quick shout out to Cam and Zach. Obviously, Cam for the crypto stuff and Zach for the overnight news roundup. Which from that I will just sound like a seagull just bash into my window. So I'll give some headlines from our overnight news roundup. So starting off in macro and just policy news. Trump's strategic Bitcoin reserve. President Trump signed an executive order establishing a U.S. strategic Bitcoin fund. Funded by Bitcoin seized through criminal or civil forfeitures. Notably absent from this was reserves. From the reserves are Ripple, Dodge, and ADA. Those tokens fell on the news. I think obviously Cam will know more about this than me, but I think one of the interesting things about this is basically this strategic reserve. I think the key point here is it's being made from Bitcoins that have been seized or crypto that's been seized rather than them buying new ones. So one to watch on that one. The DOGE, the Doge-driven federal workforce cuts. Economists now anticipate a bigger labour market impact this year due to workforce reductions pushed by Elon Musk and business pullbacks, collectively known as the Doge-driven cut. Funny enough, I just saw, he's still there, Mr. Dario Perkins, Mr. Gold BMW himself. Sorry, but everyone needs to be aware of that fact. He did make a very valid point 2 days ago, I believe it was, on Twitter, where he said, look, it's not just the fact that loads of jobs are being cut, but it's the fact that it's a very kind of, it's not exactly a kind of environment at the moment where people are hiring, so which kind of doubles the implications of all of that. So I think he's bang on the money there. Money market inflows. Investors poured 51 billion with a B dollars into money market funds in the past week, pushing total assets to a record 7.03 trillion, seeking safety amid tariff-related volatility. Fed's Bostic 2027 voter, unlikely to have enough clarity to move interest rates before late spring summer. He believes that tariffs will raise consumer prices, but is unsure whether it will show up in the headline inflation numbers. Canada's delayed retaliation. The finance minister LeBlanc postponed a second wave of retaliatory tariffs against the US until April the 2nd after Trump exempted certain Canadian goods from the 25% tariff. US egg shortage. The US officials are scouring global markets for eggs to alleviate shortages and high prices, with grocery stores limiting purchases and restaurants imposing surcharges.
Oh dear, that's cracking news.
Oh, there we go. There. Do you know what? As I was reading it, I was like, "Where's the pun? Where's the pun?" I can't think of one.
Got to make a
Channel.
yoke out of it, haven't you?
Oh God, give it up. Please, just die. I'll take that back. That was too much.
Jesus.
Sorry. Chinese trade slips, both imports and exports, came in below expectations. Analysts suggest that Beijing is scaling back strategic commodity stockpiles, i.e., grain, iron ore, and crude. China's Foreign Ministry Wang Yi vowed to resolutely counter US fentanyl pressure after Washington levied another 10% tariff on Chinese imports. PBOC, on their policy outlook, China may cut interest rates by up to 0.5 percentage points this year, bigger than last year's 0.3, and might reduce banks, the Triple R, by 1% in 2025. That's according to the Securities Daily News. China added to gold reserves for the fourth consecutive month in February. What else we got? Bank of Japan rate and yen views. BOG sources say no hike at the March meeting, but May is possible in fresh data confirms inflationary pressures. The Japanese 10-year sovereign yields could surpass 2% this year, potentially relegating Chinese bonds to the lowest yield status among major markets. That's according to Bloomberg. German factory orders dropped 7% in January versus 2.8% expected, the largest decline in a year, reflecting a weak start for Europe's biggest economy. They are completely in the shit. What else we got? Speaking about being in the shit, the UK economy. Retail footfall improved slightly in February, but house prices fell. That's according to Halifax data amid economic uncertainty and higher borrowing costs. And the Treasury may cut funding for GB Energy in June in the June review, adding pressure to Energy Secretary Ed Miliband. What else have we got here? JP Morgan on EM debt. They've cut outlook for emerging market sovereign debt in USD, citing valuations near historical high. Valuations are historically tight and may not weather a bigger price asset correction. Um, Geopolitics, US port fees on Chinese vessels. A draft executive order would impose fees on any ship part of a fleet that include Chinese built or flagged vessels, pushing allies to do the same or face retaliation. This is quite an interesting one because obviously China are a huge shipbuilder. So they're not just saying that, oh, if the ship is owned by a Chinese company or, it's carrying Chinese goods, what they're saying is any ship that has been built in China, regardless of what it's carrying, regardless of what the company who currently owns it are doing, that might find significant port fees. There's some weird calculation they're trying to do where it's, if a fleet has X% of ships in it built by China, they will also suffer levies. So it's a bit convoluted, but it could have some major impacts. Germany's nuclear coverage. Incoming Chancellor Merz proposes expanding French and British nuclear deterrence to cover Europe, highlighting ongoing security concerns. Munitions, metal shortages, a global shortage of what's that? Antimony. Never heard of it, but it's a
Nor have I.
it's a key metal in ammunition. Could worsen as Western allies restock arsenals due to the Ukraine war. And some corporate news. Tesla upgraded by Webbush to their best ideas kind of section with a $550 price target. Costco missed Q2 revenue estimates, but reported better than expected same-store sales. Meta's AI push, ramping up voice-powered AI and next-gen Llama 4 models. That's going to CEO Zuckerberg. And I reckon, in terms of news that anyone actually wants to hear, I think that's probably about it from me. Back to you in the studio.
Fine, right. Well, we will move on to today then. In that case, it is, of course, the first Friday of the month, which means it is the US labour market report a little bit later on.
And
Oh, yeah, I have to go for another beer with you, don't I?
non-farm pints.
Before we get to all of that, though, we do have some GDP figures out of the Eurozone this morning. Final Q4 data set to show the economy having grown by 0.1% on a quarter-on-quarter basis in the last 3 months of 2024, and that would be unrevised from the second estimate, which was out about 4 weeks ago. Of course, though, the main event comes this afternoon with the February US labour market report. Headline non-farm payrolls expected to have risen by 160,000 in the month of February, a modest rebound from the 143,000 pace that we saw in January, albeit with cooler than expected weather having depressed the January number. The forecast range is frankly comically large for the non-farm payrolls print today, from 30,000 on the downside to 300,000 on the upside. Basically, no one has a clue. And of course, there are a number of factors that are clouding the outlook for the jobs print today. Of course, principally those being the issues of government payrolls, as we discussed, or as Ryan was discussing a moment ago. Not only the Department of Government Efficiency job cuts, most of which is important to mention did come after the 12th, so after the survey week, but also perhaps of more importance, the federal government hiring freeze, which will also potentially depress payrolls growth. That said, leading indicators for the jobs report are somewhat mixed. Both initial and continuing jobless claims were pretty much unchanged from the January to the February survey weeks. Meanwhile, the ISM manufacturing employment number, that fell to 47.6, so back into contractionary territory, but the services employment gauge rose to 53.9, which is the highest level since December of 2021. Other bits and bobs to look at, you've obviously got the Challenger layoffs figure, which came out yesterday, layoffs having risen by 170-odd thousand in February, although it is worth noting that about 65,000 of that was government layoffs. So again, slightly clouding the outlook. And the NFIB's hiring intentions indicator, that points to private payrolls growth of about 170k. In terms of other bits and bobs in the labour market report, of course, folk will also pay attention to the revision to the prior 2 months worth of data, as well as the other areas of the establishment survey, which are set to show average hourly earnings having risen by 0.3% on the month, down from the 0.5% pace that we saw in January, although that would keep the annual pace of earnings growth unchanged at 4.1%. Earnings growth is likely to cool because the work week is likely to have extended once more. Work week hours fell to just 34.1 in January as a result of the wildfires in California and also that colder weather. We are expecting that weakness to unwind, which in turn will have a mechanical cooling effect on the average earnings figures. Lastly, in the household survey, unemployment, that's expected to have held steady at 4% on an unchanged participation rate of 62.6%. Of course, the jobs data is potentially likely to be a little bit messy, given everything that's going on with the federal government, but it does feel like the report is unlikely to materially impact the Fed policy outlook. We heard from Governor Waller yesterday, who was saying that a March rate cut is unlikely and pretty much off the table, and also policymakers continuing to focus on inflation making progress back towards that 2% target. That said, it is worth bearing in mind that given how shaky market sentiment and confidence is, and given how pessimistic every man and his dog has become over the state of the US economy, I think we are likely to see a considerably bigger risk-off reaction on a soft payrolls report than we are a risk-on reaction if the data comes in better than expected. As we were discussing earlier, it does seem that the market is firmly in a mode of rally selling, so I would expect equity gains to be somewhat limited. In terms of other bits and bobs on the docket today, we do also have labour market figures out of Canada. The economy in Canada are expected to have added about 20,000 jobs in the month of February, a pretty chunky slowdown from the 76,000 that we saw in Jan, albeit unemployment is seen rising to 6.7% for a prior 6.6%. That data, of course, coming ahead of the Bank of Canada's policy decision next Wednesday. Money markets at the moment pricing around an 80% chance that the BOC do deliver a 25 basis point cut at that March meeting. On the subject of policy, we do have plenty of speakers on the docket today. We are due to hear from the ECB's Lagarde, Nagel, Knott, Panetta, Escriva, Centeno, Kazaks, and Villeroy. plus anyone else who decides to get in front of a microphone, as is often the case after an ECB policy decision. They all want to have their say. There's also a busy day of Fed speakers as well, with today being the last day before the Fed's pre-meeting blackout period gets underway. We are due to hear from Fed Chair Powell. He will be speaking at 5:30 London time this afternoon. And we're also due to hear from Bowman, Williams and Kugler in addition to that as well. And of course, the standing reminder that we have to give every week is that there is the potential for significant gapping risk in financial markets over the weekend, depending on what Trump or Lutnick or Besant or anyone else has to say on either the geopolitical or the trade front while markets are closed. And that is pretty much a lot from me this morning and for this week.
Wonderful. Thank you very much, my dear friend, not just for today, but for the entire week. And well, just for being yourself, really, just for being a top bloke. Listeners, thank you
Well,
so
what do
much.
you want from me?
A pint. I'm not stupid. Listeners, thank you so much for tuning in as always. I see a few of you listening in are going to be joining us later on at the Token House. For those not aware, if you're not aware already, myself and Michael Brown are going to be in the Token House from about 4:30 onwards for the first of potentially many monthly beers on Non-Farm Day. So yeah, come and join us. But yeah, basically, have a great week. Remember to factor in the fuckery, and we'll see you on Monday.
Indeed. Goodbye for now.